Hello. This next reading in macro addresses the world of monetary and fiscal policy. I think without doubt probably one of the most interesting readings and kind of entertaining readings to get through in the world of macroeconomics, because we all know something at least about monetary and fiscal policy and how they've been applied over the last few years, if not decades. So without further ado, let's get into it. We're going to summarize monetary and fiscal policy to begin with. Then we'll get into monetary policy and finish off with the world of fiscal. So first up, monetary. Let's define it. It is the management of the supply of money and credit into the economy. An expansionary monetary policy aims to increase the money supply. Think of interest rates as the cost of money. So if you're increasing the money supply, the cost of money, the interest rate should decrease. Decrease in interest rates should therefore increase aggregate demand. Well, why is that? Think opportunity cost of consumption. Lower rates, lower opportunity cost of consumption. People spend more, consume more. So aggregate demand, C plus I plus G plus X minus M. Increase consumption, you increase aggregate demand. You should also increase prices and asset values, lower interest rates, lower discount rate. People are wealthier, more investment opportunities, and so on. We'll talk about that in a little bit more detail in the reading. Contractionary is the opposite, to cool the economy down, decrease the money supply, and increase interest rates. And all of the opposite arguments would apply. So that's a brief overview of monetary policy. Fiscal, government spending, taxation. So once again, aggregate demand, C plus I plus G plus X minus M. Government spending, that's G, boosts aggregate demand or cuts it. Taxation, well, increased taxation and you are cutting personal disposable income and hence consumption. So expansionary fiscal policy, you would increase spending. So we want to boost G. G will go up. And so could do both, could do one or the other, decrease tax revenues. So government spending up, taxation down, that's expansionary. That should kickstart aggregate demand. Downside, if you are spending more as a government and collecting less in taxes, you are going to increase your budget deficit. Contractionary, again, is the opposite. So you would cut government spending and increase taxes. Bonus there, whilst you're reducing aggregate demand, you are decreasing that budget deficit. So quick overview of the two. We know what they are. As I say, we'll get into monetary policy and then go on and discuss fiscal. So monetary policy, first of all, let's talk about money. What is it? What does it do before we can start to manage it? So I don't think this is going to shock anybody at all. It's a medium of exchange. I think you're aware of that. The point is, it allows trade to happen much better than a barter economy. So if you're trying to swap goods, give some financial advice to the barman in exchange for a beer, it's a much more tricky situation. So money is kind of standardized unit of accounts. It's also there as a store of value. As I say, I don't think there's too much in there to talk about. Definitions, not that much in the CFA in terms of pure learning, but this is certainly one of them. How do we define what money is in the economy? Way back in the day, it was fairly straightforward. If you had gold and silver coins flying around, you would count them up. That's money. Nowadays, we have the fractional reserve system. So you have cash in your hand. You also have deposits. Banks can create money using that fractional banking system. So it becomes a little bit trickier to calculate the actual money in circulation. Two definitions you need to be aware of, narrow and broad. The idea of narrow money, we're trying to count just literally the currency that's flying around, that's extremely liquid, that can be used to spend immediately. So that's currency in circulation, checkable deposits and travelers checks, known as M1 in the US and Eurozone, as opposed to broad money, which brings in those less liquid assets. So take your narrow money and add to that savings deposits, time deposits, and mutual funds. So narrow plus all of these three will give you your broad money. So their definitions, you may be asked just to quote those in the exam. I've mentioned this fractional reserve banking system. It's another LOS to be required to explain exactly what that is and how it works. Here's a great example. The idea is this. Each bank is required to only hold a fraction of its deposits in reserve. So I put $1,000 into the bank, and that bank is only required to hold a fraction, the required reserve ratio. For example, 20%. And these are just examples. It's a global exam, so you're not expected to know exactly what local legislation requires. So let's just say it's 20%. Bank receives $1,000 in new reserves, so I've put $1,000 of my cash, it's mine, into the bank. Only required to hold 20%, so it needs to hold $200, but it can loan out the other $800. So look immediately at what's happened. The bank still owes me my $1,000, but somebody else is now loaned another $800. From my $1,000 going into the bank has just created another $800. Assuming, and it's a big assumption, but assuming that $800 goes into another bank, that bank is only required to hold 20% on reserve, hence 80%, the 640 can go out again in a new loan. So they've just created another 640. Of that 640, only 20% is on reserve, so another 80% is loaned out, and so on, and so on, and so on. That can go on forever. Obviously, the new loan amounts are getting smaller and smaller and smaller. So if we take the previous slide to an extreme and keep creating more and more and more and more and more cash, we can actually work out that in total, if we have a reserve requirement of 20%, we would get a maximum deposit expansion multiplier, as it's kind of handily titled, of 5. Simple bit of math, all we need to do, so that equates to 20%, is take 1 divided by the reserve requirement to get 5 times. So my cash of $1,000 into the bank will create 5 times that, $5,000 in total. So this gives the authorities a tool to try and control the growth of the money supply. So it's decided by the central authority, whoever it might be. We'll talk about the roles of the central bank shortly. May increase the reserve requirement. It's up to them what the reserve requirement is. If they increase that reserve requirement, so let's say in my example, we increase it to 50%, so 1 divided by 0.5, that would give us a multiplier of 2 times and hence decrease the money supply. So that is the fractional reserve system, how it's used. We'll talk a little bit more about how it's put into practice as we go through the slides. Next up, the demand for money. Why do we need money in the first place? We've talked about its role. Obviously, it's demand for either investment, transactions, and so on. We need to break it down into 3 different types of demand. First of all, probably the most straightforward and obvious, transactions demand. That will increase with GDP. I think that's fairly straightforward. So more GDP means more transactions, more demand for transactions. Precautionary demand, kind of self-explanatory. That is a buffer held for unforeseen future needs. Be aware that will also increase with GDP. So the amount of cash you keep as precautionary demand, the amount of buffer you need, is going to be related to the size of the transactions that you undertake. So if you are a mid-sized company, you may have, let's say, $3 million sat as precautionary cash. As you grow, well, if you're growing, that means GDP is growing, and you're a much larger company with a much larger level of transactions, then you'll need a bigger buffer. So you would expect that precautionary demand to grow with GDP. Another way to think about it, you'd expect the precautionary demand to be a given percentage of GDP. That percentage will stay constant. Hence, as GDP grows, your buffer, your precautionary cash will also grow. Finally, speculative demand. We're talking here really about cash that sat just as cash rather than being invested. So we're talking about whether we're in a risk-on or risk-off environment. Sat there to take advantage of future opportunities. If current returns are high, well, that's going to be fairly small because everything is invested. But if we perceive risk to be high, if we think prices of assets are falling, then we'll have more cash sat there, and that's referred to as our speculative demand. That's the demand. At the bottom, a quick note. We're assuming here the supply of money is set by the monetary authority and hence is fixed. Now we've got the supply for money, we've got the demand for money. We can't resist putting them together on a supply and demand diagram and finding the equilibrium. And there it is. Here's money demand. On the vertical axis is the interest rate. To tie this back to microeconomics, let's just think of the interest rate as the price of money. So very high prices, low demand, and vice versa, your classic downward sloping demand curve. Supply for money, fixed. So perfectly inelastic. At this point here, it's decided by, as we said, the monetary authority. So your demand will tell you the equilibrium price for money, which is the equilibrium interest rate. And the laws of basic economics should tell us the interest rate is always going to find its way back to that equilibrium rate. Let's say, for example, at the moment the rate is too high. So we're at I high. At that point, well, the supply is always fixed. Here's demand, reading off from the demand curve, quantity of money demanded. Here's the supply. We have an excess supply. From our basics of microeconomics, with an excess supply, the price is going to fall. In this case, the interest rate will fall. Mechanism, well, excess supply of cash. People will take that cash and invest it into securities. What happens if people start buying securities in large numbers? The price of securities will rise. Hence the return, the yields, the interest rates you get will fall. And we get back to our equilibrium rate. Opposite is true. If we have rates that are too low, now here's your quantity demanded. We have an excess demand for money, in which case people will sell their securities to get more cash. Sell securities, prices will drop, returns, yields, interest will rise and bring us back to an equilibrium. Now, don't shout at the screen if you've studied economics. If you've seen what's happened in the markets and say, hang on, what if or but? Very simple model. We're assuming there, for example, the supply of bonds is fixed, the money supply is fixed. Obviously, there are a lot of other factors which may play into this. But on a very simple level, keeping everything else fixed, that's how we get equilibrium in the money market. Quick note on the Fisher effect. We'll mention Fisher a few places throughout economics. Here's one. Classic relationship between real rates, inflation, and nominal rates. And Fisher says this. It really builds on the previous slide, the idea that we'll always, by increasing or decreasing the money supply, just end up affecting prices. As a result of that, we can say that nominal interest rates are real interest rates plus inflation. Now, the only really dramatic thing on this slide is that word expected. Real rates plus expected inflation give you nominal rates. The problem is, if you're trying to work out the nominal rate you require, you have to guess, or let's make it sound a little bit more official, predict what inflation levels will be. There is clearly uncertainty about those future inflation rates. As a result, when you're trying to work out the nominal return you require, you'll add in the real rate plus your expected inflation plus a risk premium for the uncertainty surrounding that inflation. The more volatile inflation is, the higher that risk premium will be. Now that makes for a great exam question because look at this. We are trying to calculate a riskless nominal interest rate. Despite that, we are building in a risk premium. Now, if you've never read that slide, never covered that LOS, and you get an exam question that says, would you ever see a risk premium in a riskless rate? You might say no. Bear in mind here, what we're talking about is the premium you build in for the uncertainty over that expected inflation. Okay, we've defined monetary policy and money and supply and demand. Let's start to look at the roles of central banks and some of the tools they have to control monetary policy. Roles, first of all, this is one of those learn and churn slides. It's not overly dramatic. Issuing currency, being the banker to the bank and government, banks and government. Regulate banking and payment systems, be a lender of last resort. We've seen that come into play in the last decade. Hold gold reserves, foreign currency reserves, and really our main interest in this reading, conduct monetary policy. Not all of those roles will be played by all central banks. So these are just possible roles. We need to be able to tell that to the examiner. But really, as I say, we'll focus on monetary policy. Objectives, same chat as the previous slide really. These may be objectives, may not. But we can start at the top of the slide by saying all central banks have price stability as an objective. Price stability, not zero, but low inflation rates. It's generally seen as healthy to have 2 to 3% inflation in the economy, if nothing else to ward off the horrible spectre of deflation, prices falling. So if you're asked by the examiner what all central banks have in common, we're talking price stability. Not necessarily going to target explicitly, most do. You can see there, US, Japan do not. But certainly they will look to keep prices stable. Some banks will also have other stated aims: full employment, economic growth, exchange rate targeting potential, we'll mention that later on, or long-term interest rate targeting. But it's price stability that's a common theme. Inflation, expected versus unexpected. We just need to define the two. The worst, and we've already kind of mentioned this in the Fisher effect, is unexpected. Expected inflation, well, it increases the cost of holding money because your money is not inflating, so it's losing value, and adds the cost of frequently changing advertised prices. So it's just a big admin burden for firms to have to keep changing their prices to keep up with inflation. But unexpected adds additional issues. It shifts wealth from lenders to borrowers. When lenders are deciding the interest rate they're going to charge, this may be on a 5, 10, 20-year loan, they are going to build in their expected inflation to work out the return they require. If you have unexpected inflation, it's much higher, then actually you're shifting wealth to the borrowers because you didn't build in enough inflation as a lender into your return. It also means we get less reliable supply-demand information in price changes. We didn't see it coming, could lead to incorrect production decisions by firms and a less stable business cycle. All reasons that central banks like to try and aim for a degree of price stability. Okay, that sets the scene pretty nicely. We know that inflation, particularly unexpected inflation, can be bad, so we want to try and keep a nice level of 2-3%. We know what the money supply is, we've defined it. Let's kind of hone in and focus in on monetary policy. There are 3 monetary policy tools that we're going to look at. First up is the policy rate. That is the interest rate that a central bank will charge its member banks for borrowed reserves. So we're looking at the central bank to its member banks. And in terms of expansionary or contractionary monetary policy, if we increase as a central bank, increase the policy rate, that will clearly discourage banks from borrowing those reserves. It costs more. Hence, they reduce their lending. So an increase in the policy rate would reduce banks' lending, hence reduce activity in the economy. Increase in the rate is contractionary monetary policy, trying to calm aggregate demand down. Decreasing is the opposite. It will increase lending and hence the money supply, and hence will be expansionary. Again, seen it happen quite frequently and to a real extreme extent in the economy over the last decade. Quick example, I keep saying here that this is a global paper and specific local legislation is not examinable, but the reading does make a point of highlighting the US Fed, Federal Reserve, and their role. They are setting a target for what's known as the Fed funds rate. That Fed funds rate is the rate at which banks lend short-term to each other. Now that is clearly going to be heavily affected by the policy rate. The The policy rate is the rate the central bank charges member banks. The lower that is, the cheaper it is for member banks to get reserves, and hence that should bring down the Fed funds rate. So that's one tool, the policy rate. By far the most often used, however, is the second one, open market operations. That is the central bank either buying or selling government securities. If the central bank buys government securities for cash, think of the direction of this transaction. The central bank is buying securities, so it's taking pieces of paper from its member banks and putting cash into the economy. That will increase the money supply. That is expansionary. Selling securities, that's giving pieces of paper back, taking cash away from the economy. That's decreasing the money supply. That is contractionary. Open market operations, buying and selling government securities. Be careful on the wording here. It's not issuing, that's the Treasury. It's buying and selling government securities. And finally, the required reserve ratio. We mentioned this in the fractional banking system. You reduce the required reserve ratio. That will increase excess reserves and hence the money supply. So cut it from, I think I said, 20%. If you cut it down to 10, more cash goes out into the economy. Increasing that required reserve ratio will decrease the money supply. I think I wrote down an example where we went from 20 up to 50%, hence takes down the money supply, and that would be contractionary. They are three tools. It is an LOS in the exam to know that open market operations is the most frequently used. How does it work? Well, here is what's kind of referred to as the transmission mechanism, and view this slide as what will happen if everything goes nice and smoothly. We'll talk about the limitations of this later on, but if everything goes exactly as we hoped, if the central bank, the monetary authority, is acting in a nice, credible way, this should happen. So we could write this slide out for contractionary, but just be aware, this is for expansionary monetary policy. Just reverse it for contractionary. This is what we hope will happen. Four things to look at and learn. First of all, market interest rates fall. Makes sense. Expansionary monetary policy, increase the money supply, more cash available, the price of cash, i.e. interest rates, fall. That means there's less incentive to save. Less incentive to save means an increase in consumption. So aggregate demand is C plus I plus G plus X minus M. So you're boosting aggregate demand. Interest rates falling means asset prices are increasing. Think of an asset price as the present value of future cash flows. Well, you bring interest rates down, you are discounting those cash flows at a lower rate, higher asset prices. That means people feel wealthier, and hence, once again, consumption increases and aggregate demand. Number three, expectations for economic growth increase. People see rates falling. They know that the central bank, the monetary authority, is trying to stimulate growth. If the monetary authority is credible, people therefore expect growth, maybe expect further decreases in interest rates. And we said, back at the start of macroeconomics, if you have expectations for future growth, encourages consumption, investment. And number four, our external economy. Your domestic currency depreciates. The argument here, interest rates are falling. Interest rates are falling, then it's less attractive for people to hold your currency. They will sell your currency and your currency will depreciate. Depreciating currency means import prices are now higher. If import prices are higher, it's more expensive for us to import. That means import levels are falling. Export prices, if our currency depreciates, it's cheaper for our neighbors to buy our exports. Therefore, the level of exports increases. Hence, X minus M is increasing, as is aggregate demand. All four heading towards an overall impact increasing aggregate demand, which is the point of expansionary monetary policy, boosting real GDP and employment and inflation. That's at least the theory. We will talk about the limitations. Central bank characteristics. I mentioned a couple of times there as we went through that transmission mechanism that that's how it will work if we have a credible bank. For the bank to be most, or central bank I should say, for the central bank to be most effective, 3 characteristics required. 1, some degree of independence. So let's not have a big debate about this, and clearly I'm talking to you from a pre-recorded screen, so debate would be difficult. But bear in mind when we talk about this slide and say independent, yes, realistically it's always a degree of independence, but you need to be able to define 2 types for the exam. So independent means free from political interference. You may be, and I'm actually going to start with the second one here, you may be target independent, meaning, and a good example is the ECB, European Central Bank. If you are target independent, it is up to you, the central bank, to set the inflation target. So you set the target, you measure inflation, and you determine when you're going to meet that target. That is more independent, a higher level of independence than simply operational. So target independence is more independent than just operational. Just operational, the UK would be an example. Just free to set the policy rate. So here, the government has set the targets. All you're doing as a central bank is then setting the policy rate to try and meet those targets. So more independent you are, the argument is the more effective you can be. Secondly, mentioned this a few times, you should be credible. And thirdly, transparent. Credible means you follow through on your stated intentions and policies. Remember, one of those transmission mechanisms was people's expectations. So the bank announces an expansionary monetary policy. That leads to expectations of growth. That will only happen if you follow through. So if consistently you reverse your policy and say we're going to be expansionary, and then a week later, well, no, we're going to hike rates again, people don't know what's going to happen and they will sit on the sidelines. If you follow through on your stated intentions, then people will actually believe them and act in a manner you can predict. Transparent disclosure reports, indicators how you use them, and again, people can anticipate what's going to happen in the economy. So independent, credible, transparent banks can influence expectations a lot more, and hence policy changes are a lot easier to implement. So they're your characteristics. How does monetary policy affect the economy? Well, we've talked about the point being to increase aggregate demand. Let's look specifically at how we might do that using open market operations. Remember, this is the most common monetary policy tool. So if we are buying securities, remember, buying securities, you're taking pieces of paper, rights to future cash out of the economy and pumping cash in. That is expansionary monetary policy, hence trying to increase aggregate demand. Effects, putting cash into your bank so reserves increase, makes sense. If banks have higher reserve levels, in theory, they're more willing to lend to each other and the interbank lending rate should decrease. Again, let's hold fire on any limitations for later. Short-term and long-term lending rates decrease. Okay, again, hold fire on any limitations, but at least in theory, more cash around. As we said earlier, interest rates will fall. Rates fall, lending rates fall because people are more willing to lend to each other. Businesses increase investment if they have expectations for growth. And if lending rates are lower, easier to get finance, more investment. Consumers increase goods purchases. And as we said earlier, domestic currency depreciates, boosting exports and cutting imports. So you can see how the transmission mechanism plays out in the real world if it all works. Okay, how might the bank target, or what, I should say, might the bank target? Again, this is not every single central bank. These are just options. So, first of all, you may have an interest rate targeting approach. If that's the case, you will increase, for example, the money supply when interest rates are above your target. Think about that. You increase the money supply, you are putting more money out there, bringing down the price of money, bringing down the interest rate back to your target. Most banks, as we said, not all, but most will specifically have a target inflation rate. We mentioned earlier in the reading, 2 to 3%, could be anywhere between 1 and 3%. Idea is a little bit of inflation to prevent deflation. So if you've got a target band, you'll increase the money supply growth when inflation is below the target band. Why? More money out there, bring down interest rates, increase consumption. Increased consumption is a good thing for the economy, and it is argued will boost GDP. Now, there is a counter-argument to that. Again, we can talk limitations. Counter-argument, all you're doing is changing price levels, not the amount of stuff produced. But in theory, increase the money supply growth, decrease when inflation is above the target. That will cut the amount of cash chasing goods and therefore bring down inflation. And as I keep saying, your target is above zero because we don't want deflation. We'll mention again later why as part of the limitations. You could target your exchange rate. Less common, certainly. But if you are targeting your exchange rate, and there's one very huge example in the world, which we'll not get into, I don't want to get too political, but you may target your exchange rate simply to try and manage your economy, keep it more stable, or to manage your imports, exports. To do that, you will sell your domestic currency when the rate is too high. So your economy, I should say your currency is becoming too valuable. Sell it. Basic economics, you're selling your currency, you'll bring its price down, i.e. bring down its exchange rate. Downside is you're reacting to your exchange rate, not domestic economic conditions. So it makes it very difficult to manage both your exchange rate and use domestic monetary policy. If you're successful trying to keep your exchange rate targeted, let's say you're a developing economy and you're trying to match it to a developed, you should effectively import the inflation rate from that developed economy. So try and keep it fairly stable. So it could be inflation, could be exchange rates, or we could go on and target interest rates. Now, to help with interest rate targeting, if that's indeed the direction the bank wants to go, or the central bank wants to go, it's helpful to identify a neutral interest rate. Fairly straightforward this, but it's a good little exam question, I think, potentially. Just to define the neutral interest rate as trend growth in the rate of real GDP plus your targeted inflation rate. So really we're talking here about trying to get towards interest rates, but using our target inflation rate. If the policy rate implemented is greater than that neutral rate, that is a contractionary policy. So some very, very simple numbers. If the trend growth rate of real GDP is 3%, you're targeting inflation of 2%, a neutral rate would be 5%. If you're currently operating at 7%, well, that's greater than the neutral rate. That interest rate would therefore be seen as contractionary. Anything below 5% would be expansionary. So it's worth just having that in your head and be able to dump some very simple examples in there. Been mentioning these as we go along, so let's just finish off the monetary policy section with limitations. So we saw 2 slides, the transmission mechanism and the impacts. If it all works well, we're credible, great stuff. But a couple of problems, a couple of slides worth of problems. Number 1, long-term rates may actually go in the opposite direction to short-term. Why? Old friend, inflation expectations once again. So, problem is this. Let's say you're being expansionary. So, you're trying to cool the economy down. That's not true. Let's say you're being expansionary to try and boost the economy. So expansionary monetary policy, you're trying to kickstart the economy. The idea is you put money into the economy, you bring down interest rates. Well, if people now say, right, I can see what's happening, you're kickstarting the economy. If you kickstart the economy, you're going to introduce inflation. Well, interest rates, as we talked about earlier with Fisher, are real rates plus inflation expectations. So if we now think you're kickstarting the economy and introducing inflation, longer term rates might build in higher inflation expectations, and you've got short-term rates dropping if you're being expansionary, but long-term rates then actually increasing because people's expectation of inflation goes up. So that might blunt your impact. Secondly, this really is about kind of credibility. So monetary tightening, let's say, is extreme. So the bank's really going to town on shrinking the money supply. And it may be that if you're not that credible, people don't trust you or agree with you, they may say, look, I know what you're doing. Tight monetary policy is to try and calm down a boom. But if people think you're going too far, they might say, look, all you're doing here is leading us into a recession. Now, if you're leading us into a recession, that might rather make the long end of the yield curve more attractive, long-term bonds more attractive, and bring down those long-term rates. Because now we're switching to bond investments because we're heading to recession, and people are kind of pulling off in their risk levels. So it's all about where, if you like this term, bond vigilantes think your extreme policy is going. If you're credible and people think you're doing the right thing, it's not an issue. But if you're volatile, lack credibility and transparency, then people start to move the yield curve independently of the central bank. Thirdly, the nightmare of the liquidity trap. Demand for money becoming very elastic, and in the extreme case, perfectly elastic horizontal demand. And just go back to our nice simple curve from earlier. Money supply, demand. Doesn't matter now what you do with the money supply, even if you start bouncing it that way. People don't spend, they just hold their cash. That's known as a liquidity trap. The whole point of monetary policy, you put cash out there and people start to spend it to boost consumption and boost aggregate demand. If they don't spend, that's your liquidity trap. Let me just mention here, deflation. That is the specter that hangs around deflation, liquidity trap. The idea is if people see prices falling, there's no incentive to go out and consume today. In a deflationary environment, prices are going to be cheaper tomorrow. So why buy today when you can buy cheaper tomorrow? So deflation can bring with it the specter of a liquidity trap, one big reason that monetary authorities will try and avoid it. Fourthly, and don't jump ahead to point 5 yet and start to shout at the screen. But fourthly, banks may desire to increase their capital buffer rather than lend. Again, we've seen that in the crisis in the last decade. So banks increase their capital because they need a capital buffer rather than lending to each other. So you give them cash in the hope the banks take the cash and start to lend. Instead, they just sit on it. And finally, short-term rates cannot be below zero. I know we've seen negative real rates over the last decade or so. They do happen, but they really are a limit to the central bank's ability to act against deflation. Once you've brought rates all the way down to zero, there's really not much more scope for you to bring them down again. If you like, your monetary cupboard is bare. So once prices start to fall, you've lost that tool. Again, one of the real fears of deflation. Really nice reading this, as I say. That wraps up monetary policy. We defined money, what it is, the supply and demand and equilibrium rates, then the roles of the central bank, and probably the key thing, the tools they can go out and use, and finishes off, as most economics lectures do, with the limitations of everything we've just talked about. That's monetary. We'll move on to fiscal.